Hello, everyone. This is Kathy. Give you 1 second to share the correct screen. Good morning, everyone. If you can hear my voice and see my screen, please say hello in the chat Kathy box or in the questions chat box in YouTube, and I will be getting going in just a second. I just want to get one message out on social about this Japanese intervention, which we'll talk about in just a second, if you'll bear with me. Hold on. Okay, tell me, good morning, everyone. Tell me where you're coming in from. Are you coming in from the US? It's been a week since I've spoken to you. And so I am so glad to be back for this busy trading week. Just give me 1 more second. Big moves in dollar yen at Asia and New York Open. This smells of intervention. Hold on, and I'll show you the charts in a minute from Ministry of Finance through the Bank of Japan. We won't know until, hold on. We won't know, and I'm going to show you, we're going to look at the dollar yen charts together in a second. Let's get rid of these indicators. We'll look at these in a second for sure until there is verbal confirmation or the MO or they release their monthly data. Okay. All righty, got that out. So let's talk. All right, so you should all be looking at my dollar yen chart. Let me just make sure I have my Q&A box up so that I can see everyone's questions, make sure everything's looking good. Okay, Wonderful. So good morning, everyone, to Kathy's Caffeinated Market Buzz. So much to talk about this week, so much to talk about today. But what's what I guess interests me the most, and probably you, is these huge moves that we've seen in dollar yen. Now, a couple weeks ago, we had some good sized moves, quick moves, and I had posted a chart saying that this is not intervention. But this is very much indicative of intervention, because if you look here, this over here is not intervention. This is basically dollar yen rallying above 160, and orders, take profit orders being filled, stop orders being filled, just the small move, about 100 pips, is just order filling. This over here, 570 point move in dollar yen in a matter of, and the first move in the first 5 minutes was about 200 pips. So 570 point move from, I guess my time, midnight 05 to 105. This 1 hour period, we had a 570 point move in dollar yen. And so this is a huge move lower in dollar yen. Over here, we also have, this was right at the Asia Open, or right before the European Open. And right over here at the European Open, hold on, I think I made a mistake in my post with the timing. Hold on, I'm just gonna repost it. But basically the point that I want to make is that what we have over here is that this is a 250 point move. Okay, so it's around the European Open. Hold on, sorry, I'm trying to get these charts out as well. So yes, right around the European Open is when we had these moves. And so we had these moves, they're obviously very, very big moves. And 200, so I'm going to mark this arrow over here too. So 270 point move along with the 500, and let's just mark this over here so all of you see how significant it is. Let me get the right numbers here. 570 pips. What is going on? Okay, 570 pips. This magnitude and this move over here that you just see is also a move that happened between, what is it, 3:05 and 3:35. So a 30-minute move. So in a 1 hour span, and in a 1 hour span, and also in a 30-minute span, we got these multi-hundred pip drops. And so this is what intervention looks like. And what I also want to point out to you is if you will look at this closely, you will see that with the intervention, you have the intervention, and then you pretty much have a retrace. And you have an intervention, you have retrace. Now with intervention, the main things with it is that, if you want to sell, you've got to sell quickly, because usually the move is kind of like when we trade big event risks like non-farm payrolls or inflation data. You've got to be in and out. Usually the max of the move, this was an hour, but you can't expect the move to last more than 20-ish minutes, 20-ish, 30 minutes maximum. So if you start to see a huge candle, multi-hundred pip move, then you expect a little bit of a retrace, and then, or just jump right in for a maximum of a time-based trade, about 20, 30 minutes. This one you got more, but then there's a retrace, and so this is where you can use whatever indicators that you want to help you pinpoint a better entry level. Now I've got a lot going on here, so I'm going to hide some of the longer term moving averages, but perhaps if you used just the 20 SMA and you waited for it to go back down below the 20 SMA, then maybe that could be an opportunity to get back in. Or at other more inflection points, like for example, we know that this is an inflection point over here where it stopped there. And then we know this is an inflection point there from these lows here. The second time they came around, I would say this is about the inflection point. So those are the levels that I would be watching. So if we drop right now, if we drop back below here, maybe to 156.25 or so, I think that, you know, we may end up having a further leg lower in dollar yen, especially with yields lower and the market now seeing, you know, finally getting a taste of intervention and seeing what could happen. And basically, you know, being worried about that and starting to take profits on some of their intervention, some of their long dollar yen positions. Now, with that said, though, I do have to say that intervention itself historically is rarely effective unless it is coordinated intervention. And this, you know, is not coordinated intervention. This is purely something that is from the Japanese themselves. We haven't heard confirmation verbally from the Japanese government. Now, it's going to happen one of two ways. Either they're going to come out straight up and said, you know, we came into the markets, we're unhappy with the move, or they're going to wait to publish their monthly data on the Ministry of Finance's website. So we may have to wait, you know, until a while to get the information. So, you know, that is something that is important to pay attention to because they may not release it until next month. But looking at the levels, if we get back below this inflection point and, you know, definitely below over here, which is this low over here, 156.13, we could be seeing a more significant move lower. Now, if we get above this line, though, we could see a more of a retrace up to, I would say, this level over here. So those are kind of the inflection points and the key support and resistance levels in dollar yen right now. But for those of you that are joining us late, these moves in dollar yen, 570 points, 250 points in a matter of minutes is definitely indicative of Japanese intervention. And so we've seen it. And if we go to our daily charts and get rid of some of these drawings, this is the type of intervention-based move that you typically end up seeing. And, you know, it's still though, dollar yen is in an uptrend. You know, the last time they intervened was in, I think, October of 2022. Looks like this candle here. So basically we look like this right now. So we look like this, which, you know, if history can be a guide, what does that tell us? That tells us if we look like this, we may end up having a new drop lower at the Asia session, followed by an aggressive retrace, followed by, you know, a more significant move lower. But this here was coincided with the drop in US yields. So that would kind of require the Fed, you know, to be some sort of suggestion that, you know, maybe, or confirmation that maybe July is when they're looking at for an interest rate cut, or September, some sort of, you know, more dovish comments from the Fed, or very weak non-farm payrolls number. That's what, you know, US yields are already lower. Investors are worried about non-farm payrolls, which we'll look at in a second. But that's what would really mark a top in dollar yen. Here we see a similar scenario that took a little bit longer, where we had a huge drop in dollar yen. And this is also indicative of intervention because 146 to 140.20, which is a 630-point move. This is Japanese intervention. 630-point move, followed by a push lower. So you have an opportunity for a push lower, followed by a retrace before a new leg lower. So going back to today's movement, we looked just like that October candle, where we have a huge multi-500, you know, actually in this case, 570, I think, point move overall, something along that lines. But this definitely suggests that we could be looking at a top in dollar yen, but that would need to be confirmed by weaker US data or less or more dovishness from the Federal Reserve, because we certainly got nothing from the Bank of Japan last week. The Bank of Japan left interest rates unchanged, didn't really suggest that they were in a rush to raise interest rates again, didn't really express too much concern about yen weakness, kind of left the ball in the Ministry of Finance's court, which is what we're seeing today. And so we're not getting support for monetary policy. And unless we get, the Japanese coming in and saying, again, this is not a one-off move, we're going to come in, we're very much willing to come in again to drive the yen, dollar yen lower, drive the yen higher, then that's when investors are going to get worried. But if they think it's isolated and they don't think that the Japanese are going to necessarily come in again, then it may not last. So as I said earlier, the levels that you should be watching is, first off, on a very near-term basis, and we drew some of these charts earlier for those of you that are joining us late, but from a very near-term basis, I would say that somewhere around here is the resistance level in dollar yen. And then in terms of the support for a potential move lower, I would say it's somewhere around this low here are the levels to watch for the next move upwards or the next move downwards. All right, so this is a huge week for the markets. We're starting the week off with a little bit of risk on. Stock futures are up. We have US yields lower, and we have the US dollar down across the board. So, we are looking at a situation where we do see dollar selling off. And the reason selling off is because of this. On Friday, we have US non-farm payrolls. And US non-farm payrolls are expected, this actually got updated before I was looking at below 200,000, but US non-farm payrolls are expected to come in around 240, which is a weaker number, but still a pretty healthy number. But I think, given how overstretched the dollar had become, the market may interpret any weak number as reason to take profits on their long dollar position. Also, it could come in weaker than this. I mean, 240 is still a very, very hot number in light of things. And so, I think that the market is thinking that there could be a bigger downside surprise, and they're kind of protecting themselves against it. So in terms of the Fed, the two main events this week are the Federal Reserve monetary policy announcement, along with the non-farm payrolls report. And so with the Federal Reserve's monetary policy announcement, you can see that June, the market expects, the Fed, there's an 89% chance that the Fed is going to leave interest rates unchanged, pretty much a certainty. July, the market is pricing in only a 31.5% chance of a interest rate cut, which is not that significant at all. I mean, it's below 50%, which means that the market has now pushed its expectations for the first interest rate cut from the Federal Reserve to come in September. So right now there's a 60% chance of a September interest rate cut. Sorry, 60 is not huge, but 60 is greater than 50. And so this is what everyone will be listening to. Will the Fed confirm that that September is when they're going to lower interest rates, or could they come in sooner in July? It could be either scenario. A full rate cut is priced in for the year, you can see, but the curve has definitely shifted significantly. And the ECB is still expected to lower interest rates in June. They've been pretty vocal about telling us that. And so there's a huge divergence there, which can still create opportunity for euro dollar. But for the Fed itself, you can see the market is not positioned for any type of caution, any type of renewed dovishness. And that could come from the Fed or come from non-farm payrolls. So the market and the Fed fund futures are not positioned for that. And yet we are seeing the dollar pull back, against all of the major currencies. Let me get rid of this. All of the major currencies against the dollar, against the euro, ahead of all of these events. Euro very much remaining under pressure, because even though we had inline inflation data, the sentiment numbers were weaker. And in general, I would say that because the Federal Reserve is expected to lower interest rates so late, and the ECB is expected to lower interest rates in June, that Eurodollar still remains very much under pressure. All right, let's go to my heat map. So I'm dollar neutral this week. I'm dollar neutral. I'm neutral bullish. I'm neutral because I think there could be profit taking. I think that the non-farm payrolls number could surprise more significantly to the downside. I think that we could have a situation where we just see profit taking in general. So with big events like FOMC and non-farm payrolls, I think it's always better to let these events happen and then trade on the back of them. So I'm neutral because they can go either way. I'm neutral bearish euros. I'm neutral euros because data has shown a little bit of signs of stabilization. Inflationary pressures still remain hot, but we've got a lot of data, inflation data, as well as GDP data this week. So those, inflation data could still remain relatively firm. GDP data is something that, we watch closely, but it is a little bit backwards looking. But with the GDP data, also, because German retail sales and trade was stronger, we could have stronger GDP numbers. But overall, I'm still bearish euros, neutral bearish, because I think that the ECB is going to lower interest rates before the Fed, and any rallies will be sold. I'm neutral bearish pound as well. BOE has been quite clear that the market is correct in its pricing for an interest rate cut from the central bank, and the market's basically pricing in a summer interest rate cut in between June or July. So that will also be before the Federal Reserve. And UK data has been really kind of mixed. These tiles, you can click on them. They'll tell you ugly jobs number, stronger inflation, weaker retail sales, PMIs mixed, manufacturing weaker, services. Data has been very mixed. We don't have any UK data this week. So pound is going to trade exclusively on the market's appetite for dollars as well as euros. But I'm still neutral bearish pounds. I'm bullish Aussies. Aussie is, the unexpected job losses, but and data hasn't been great, but they are not expected to lower interest rates until the latter part of this year. And they are only expected to lower interest rates once. So overall, when I say that when it comes to trading fundamentals, the one thing that you should pay attention to is where interest rates are headed and who's going to raise or lower interest rates first or last. And the RBA is expected to be one of the last central banks to lower interest rates. The Canadian dollar, we have, from Canada this week, the BOC in no rush to cut interest rates. CAD jobs report and spending and CPI were weaker, but IB was stronger. This week we have GDP numbers which are expected to possibly come in stronger. So I'm still relatively bullish CAD compared to some of the other currencies. I'm bearish Kiwis. The PMIs were very ugly. We have jobs data this week. Jobs data could be a little bit firmer, but in general, CPI growth slowed, PMI is weakened, economy's fallen, technical recession. I'm definitely more bearish Kiwi than Aussie. Swiss franc, I'm neutral. We have Swiss inflation data this week. Overall, SNB was the first to lower interest rates. The franc is still remaining underperforming, but I think overall, it's really going to trade on dollar and euro flows. Yen, I'm neutral bullish. I know I switched this, I switched this on Saturday before the intervention, and I'm going to switch this back to bullish, but I'm still bullish the Japanese yen. Overall, if you're joining us in late, I talked about how all the moves that we saw today definitely smells like intervention. And I think that we've gotten the intervention move, and investors will be worried about more to come, and they're going to be, quite possibly driving the currency even lower as a result. So definitely more upside now in the Japanese yen, basically what we've been waiting for. For BK members, usually I create the FOMC table. We're going to review it tomorrow because I was away on vacation. I didn't have time to create the table. I'll do it today, and we'll create the data table for Federal Reserve and look at how the economy changed and what the Federal Reserve will be looking at tomorrow's live stream. And if you're not a BK member, definitely consider joining us, because we do a lot more than what we do today on Mondays. So on the calendar, starting off with what we've got already today. First of all, we also have a lot of holidays this week for, May holidays at the beginning of the week, at the end of the week. Sorry, this is not the right day. We had Japan on holiday, and I believe China was on a holiday yesterday, Japan on holiday. So they actually intervened on their holiday, which, I guess they're trying to take advantage of lower liquidity. But in terms of the data that we've had, the inflation data from the regions wasn't really that bad because, for example, Saxony had higher prices. North Rhine had higher prices. But from Germany itself, the German inflation data was mixed. The monthly inflation rate and year-over-year rate was lower, but the harmonized rate, which is a more smooth rate, was higher. Overall, inflation remains above the 2% target, but is definitely improving. And so it's moving in the right direction for them. And then the Eurozone sentiment numbers were weaker as well. So those are all of that is Euro bearish, which is why I'm neutral bearish Euros. Tonight, we have jobs numbers from Japan, industrial production, retail sales data, a lot of data from Japan, but I think investors will continue to be on intervention watch. For New Zealand, we have business confidence numbers. Australia has retail sales figures. And with Australia retail sales figures, we did have a drop in PMI, so this is expected to be weaker, which could hurt the Aussie a bit. We also have Chinese PMIs, and those are expected to be weaker. If they are, we see a little bit of profit taking in Aussie. And then tomorrow on Tuesday, we have German retail sales figures, which are expected to be strong. German GDP numbers, which are expected to be stronger. Labor market numbers from Germany, so a lot of very important German data. We also have Eurozone data. Eurozone flash PMIs are expected to be stronger. Eurozone GDP numbers are expected, flash GDP numbers are expected to be stronger. So that's why we're neutral right now until after these numbers come out. I'm going to update the heat map. And then Canada has GDP numbers. And with the Canadian GDP numbers, we did have an improvement in trade and retail sales. So even though the market expects a weaker number, we may actually get an upside improvement. Then we have Chicago PMI, and we have the New Zealand labor market numbers. With the New Zealand labor market numbers, we did have stronger the KPMG jobs report, and we also had stronger PMI manufacturing. So this could show a little bit of improvement. We'll have to see. And then we have Australian PMI, so a lot of data from Australia and New Zealand this week as well. And then on Wednesday is when we have refocused back on the dollar. We have ADP, and we also have the ISM manufacturing number. But of course, the main focus will be on FOMC. And with FOMC, it's going to be two-pronged. We have the Federal Reserve rate decision at 2, press conference at 2:30. Economic projections are not updated, so we're not going to get new economic projections this week. It will just be what they do, which means they'll do nothing at 2 o'clock. The statement itself, whether we see major changes in the statement at 2 o'clock. And then what Powell says at 2:30. So that's, the two-pronged event risk that we have for FOMC. And this is one of the main focus this week. And we are looking for a hold with a resistance to an early summer interest rate cut. If we get anything that is more cautious, more dovish than that, that's going to be very bearish for the dollar. Then we have Australian trade data, which is expected to be a little bit firmer. On Thursday, we have Swiss inflation data, a little bit of uptick expected there. That could be good for the franc. We also have revisions to PMIs, which are not expected to be revised. And we have factory orders from US, not a huge market mover. And then Friday, so not much going on Thursday. Friday, we have US non-farm payrolls. That's the main focus. And as you can see, market's looking for softer non-farm payrolls report. Dollar's pulling back today because investors are worried that it could be even softer than 240,000. And services PMI are also coming out. Services PMI will be less market moving since it's coming out after the non-farm payrolls report. But overall, non-farm payrolls, I don't think that 1 week jobs number will be enough to shift the Fed away from a July-September interest rate cut, but we'll know better after the FOMC. And this report will be used to confirm or whatever bias that the FOMC comes out with the day, 2 days before. So it's a very busy week, and I'll try to keep you all updated and back in the office. So, we'll be talking about that throughout the course of the week. And then in terms of levels to watch on a technical basis, euro dollar still below all of the major moving averages, still very much in the downtrend. And like I said, sell on rallies is what the direction I'm looking for. Euro dollar, I think that euro dollar is still going to be headed lower. Pound dollar's retraced a bit. It is higher today, outperforming euro, still below some key moving averages. There's a lot of resistance at the 126 level, between 125.75 and 126 level. I think that it might start to find some resistance around 126, but it's going to trade primarily on US dollar and euro flows this week. Dollar yen is the one that I'm most interested in. I think what's going to happen is you're going to see a little bit like this. You're going to see a little bit like this. And then we're going to see that if FOMC is more cautious. This part here is going to be contingent upon FOMC. But for now, because we have today and then Wednesday afternoon, I think you'll see a little bit of this, a little bit of that, and then this depends on FOMC, which way we go. If the FOMC just maintains what they have before, what I think is going to happen is we're going to get a little bit of this, and then into NFPs. So that's what I think will probably be the case. But as I said, it is a lot of moving parts, a lot of uncertainty, and these these event risks could go either way. And so we'll have to be watching them closely. Dollar Swiss consolidating near their highs. I think the dollar Swiss is nearing a top. I think it's going to move lower. Aussie dollar resistance right at the 100 SMA. These SMAs matter. 6 straight days of gains. Finding resistance at the 100 SMA. I think that we've got a lot of event risk. I think that we may pull back a little bit if Australian retail sales comes in softer. New Zealand dollar. This one actually looks like it has a bit more room to go, even though my fundamental bias is a little bit more cautious. I think we'll go there, maybe into New Zealand CPI, and overall New Zealand dollar doesn't look that attractive. And then dollar CAD still finding resistance at the 20 SMA. I think that we could see some further downside in dollar CAD. And then as for gold, Boris not joining us today, so I'll give you my thoughts on gold. Gold, very major rally, pull back, retracing. Technically, it still looks like it's moving to the downside, but it all hinges on the US dollar. And I think in reality, what's going to happen is we're going to get consolidation. And depending upon how FOMC fares, that's going to be determined which way we go. So consolidation into FOMC, and that's going to determine which direction we go in gold. All right, so now I'd like to open up the floor. Any questions you may have or comments that you may have. Paolo says, if dollar intervention is not coordinated, a short squeeze is always likely in the short and medium term, and every cap can eventually be broken. Yeah, I mean, I think it's quite possible if it's, but then again, you can argue that in October, it was not coordinated intervention either. In October of 2022, it wasn't coordinated intervention. And this is what I wanted to say. This was not coordinated intervention. But what mattered at this time was that US yields were falling. And the only way for US yields to fall is to get a really big miss in on-farm payrolls or some sort of sudden shift in guidance from the Federal Reserve, of which I don't think is going to happen. But that is still something that is a possible risk. So, you've got to be mindful of that. Okay, so what's this other question here? When checking the market sentiment for the daily session, what time frame should I look at YMNES in? Well, if you're looking at market sentiment, I always just look at the daily charts because you're looking at just the market sentiment of the day. And you basically look at the market sentiment of the day, and I look at the daily charts for the market sentiment. What are bond yields indicating? Good question. Bond yields are lower. Sorry, let me fix my chart today. So this is why the dollar is pulling back. But bond yields are not down a lot. So I think, honestly, you're probably gonna get consolidation ahead of FOMC. And then, you know, the moves afterwards, although Dolly itself could have some very, very interesting movements. Any other questions? Let me see if we have more questions. If you want to learn more about how to trade with fundamentals, I'm going to put in the link for our forex fundamentals course, and we've got a big discount link here. All right, is the dollar not affected by the war that's happening? The markets moved on for now because Iran and Israel have not attacked each other again. Everyone's hoping that that incident is, I don't want to say isolated incident, it's not an isolated incident, but that whole increase in tension is pacified for now, and they've moved on. A lot of the times these war trades, it's very short-lived, and the market moves on very, very quickly. What I believe is an algorithm to moving the market. There's always a, you know, funds that are moving, but not significantly. What to expect for the employment report? So we talked about this earlier. Job growth is expected to be weaker, but there is scope for a bigger downside surprise. 243 is not that much different from 303. But even if we get a downside surprise, unless it comes 150, 125, I don't think it's really a game changer for the dollar. Did you notice how Germany had all the releases last night at 4 a.m., but did you notice it reflected the market, such as the euro dollar? The 4 a.m. releases are less important in the euro than the numbers that came out just at 8 a.m. The numbers that came out at 8 a.m. were the German inflation data, and at 4 a.m., you know, we were just in this grind here, so it didn't matter as much, at least today. Any other questions? Do I think euro pound will hold 85? So I'm bearish euros, and you know, I think pound is just kind of neutral. I think it's going to go down to 85. Now 85 is the support level for euro pound. Sorry, these are old. 85 is the support level for euro pound all the way since August of 2022. I think it's going to test it with support. It usually bounces. The way to trade this stuff is you wait for, you trade it to 85, and then you wait for it to break it, retrace test it, resist it, and then go lower again. That's the way you trade, you know, these support and resistance levels. So you ride 285, then you wait for it to break. You do not ride the break because it's probably going to retrace, and then you go down lower. You know, this is the way you trade breakouts, and rather than trying to guess it. Was it possible to position for yourself the yen dollar trade? Well, I mean, you know, you could have said that you've just been short dollar in the whole time, but it squeezed higher. You could have said that the round numbers, 160, very big round number, you could have traded against. But the main way to trade the intervention was really, and we talked about this in the beginning, Mark, and I think it's important to revisit again, is that usually you get continuation in the first 20 to 30 minutes, and that's it. So they intervene, you jump in, you sell, you continue for the first 20, 30 minutes, and you get out. This was an hour move, but this was a 30-minute move. You get in, you get out, and then you can see that there's a retrace. So it's just like we trade news. When we trade news, you get in and you get out. You know, very quick, swift moves, and you know, very short-term moves. And that is what that's the way to trade this type of intervention. Can you talk about the NASDAQ as their earnings are low in tech? Well, I mean, yes, you're right. Earnings are weakening in tech. NASDAQ is rallying. I think that personally, if it gets towards 18,000 resistance, I think that's going to hold. I think it's going to invite sellers. I think it's going to continue to move lower around those levels. Very good questions today. I love all of the great questions that you guys have. Any other questions? It's a lot going on this week. I'll try to keep you all updated. And, you know, Boris will be doing a scalping webinar tomorrow at 10:30, and then he'll be doing his live stream trading on Wednesday. So we have a lot trading NASDAQ and gold. So make sure you stay on top of our events on the YouTube calendar. And we'll be back with you. I'll be back with all of you on Monday or every day if you are a BK trader. Any professional tip to last us until next Monday? Make sure you're trading with someone on your side, and I encourage you to become a BK member to learn how to trade with fundamentals. So because markets are evolving constantly, and you want to make sure you know what is the most important takeaways, and have someone to explain that all to you. And that's what I hope to do or I aim to do every single day. All right. Thank you all for joining me. It's been such a pleasure speaking to all of you. I'll do my best to keep you all updated. Have a great trading week. And as I said, we have a lot of events that we are doing this week, some of which are not posted on our live calendar yet on YouTube. So just make sure you stay on top of it and join as many as you can, because it's going to be a big trading week. Do we think I have more BOJ intervention from the Japanese this week? It depends. If we stay around these levels, no. If the market pushes up and it starts to test their resolve and goes back up to their inflection points. So let's see, where were they coming in at? They came in at right underneath 160. They came in at 157. So if we get back above these levels, above 157.50, I would say more 158 region, I think they'll come in again. If, however, we stay at these levels, probably not. Would I think that investors want to park their money in gold since the US and Europe are hands-on the war? I think parking money in gold is always a good idea in these times of uncertainty and in falling interest rate environment. All right, yes, last week I said, the new line in the sand was 160. And that is where they took it. So I'm glad that you found that valuable. All right, everyone, thank you so much. I want to wish you all a great trading week. And like I said, join our events, check the calendar. There's going to be a lot going on this week. Have a great day. And if you like this live stream, make sure you hit the little heart button. Let me know you enjoyed today's stream.